Eric Rice, welcome to the Financial Freedom Fast podcast. What's going on, brother?
And just rolling into the Christmas season here. Got a lot of things happening and trying to get them all wrapped up before we take a little bit of a break. But it's been a great 2022.
You definitely got some stuff going on there. So, Eric, just to jump off for the people who don't know who you are and what you do, let's hear your story. Who are you? What have you done? And what have you built up for yourself? We could start off from where you even began in real estate. What got you started?
Sure. Yeah, absolutely. Eric Rice, our company name is Rice Pegger Capital, and we're based out of the greater Pittsburgh, Pennsylvania area. So we primarily invest in Western PA. And as of right now, we invest in a number of different asset classes. We have a lot of multifamily stuff. And we also have a decent chunk of Main Street mixed use properties. So those are typically restaurant, retail on the first level or the street level. And then second, third floors are usually office typically or apartment on those deals. And those are fun. Those are kind of like historic restorations. But yeah, it started quite a while ago at this point, really. I came out of school way back in 2005 as a wildlife biologist and had a really cool career down on the southeastern coast on a barrier island and did all kinds of cool stuff. But I eventually decided I was sick of driving by all the big houses on the beach and wanted to figure out a way to eventually attain one of those. So went into residential real estate, moved up to Washington, D.C., and started up with a partner up there underneath a Remax brand there and built out a pretty significant team and kind of learned the ropes in real estate there, which was quite a bit different than what I'm doing now. But that was my entry into real estate. It was on the sales side as an agent back in 2000. I think that was 2009.
Wow. Rough time to be starting as an agent, or what was your
Yeah.
experience like there?
Yeah. And so got that comment a lot. Everybody's like, oh, you're leaving your stable government job with benefits, everything to go take a commission only job in real estate in the middle of a recession. And my thought process was that I could learn the business while things were slow and then really be ready to roll when things heated up. That ended up working out pretty well. The partner that I had there was a well-established agent and he had some relationships with like Countrywide, which then turned into Bank of America and some other lenders. So we ended up selling like a ton of the foreclosure properties of the time. And so I got like tons of inside experience with how that process worked. And I got to help a lot of investors buy properties then and help them renovate them and help them sell them. But I was always looking at it like, oh, I might be on the wrong side of the table here.
So you're a biologist, correct? And you were seeing all these big houses. It makes you want to become a person that can afford these types of houses and live that way. What made you know that real estate was the way to go there?
I always liked real estate and I was always fairly business minded. Even I was a handy kind of kid and teenager. So I liked painting stuff, putting tile down and working. And so I think I just naturally gravitated towards real estate because it was something I could grasp pretty easily. And I knew a lot of people that had made money or kept money in real estate. So I thought it was a reasonable avenue to jump in.
So what did it look like after that? You got into the agency, started doing pretty well
Yeah.
and selling these foreclosed houses, these foreclosed properties. What did it look like after that?
Yeah. So pretty quickly started making some money up there. I guess we were girlfriend, boyfriend at the time, but my now wife and I decided to buy a property in DC in an up and coming area. It was a row house, but it had an English basement. So if you're familiar with that, like you go under the front porch, it's got its own separate entrance front and back, separated from the main house. So it was unfinished in the basement, but we bought the house, finished out the basement, and that was our first rental property, so to speak. We lived in the upstairs and we had the basement rented out. So our monthly costs were pretty low for living in the DC area.
And so that's your first jump into actually investing in real estate. And what year was that?
Bought that in 2009.
2009.
Yeah.
Got it. So did that spiral into, wow, this real estate thing is awesome, let me buy a lot more? Or what did it look like after that?
Yeah. It took a long time, but it did. So all the while we were doing that, I was selling a lot of these foreclosures and I just didn't know there weren't podcasts out. There weren't these great kind of free education avenues out there. So I really just didn't know about using other people's money like that. And so if I had, I'd be done. I'd have the
Yeah.
house on the southeast coast of Florida at this point. But the what ended up happening is eventually I had a great career in DC, wanted to move back to the Pittsburgh area where my wife and I were both from. And we kept the house in DC that, and we built a brand new single family house here. And the income from that house paid for our complete mortgage payment for the house we built in Pittsburgh. And at that point, I was okay, this really works. I need to figure this out a little bit. And at the same time, all along, I was always a little bit discontent with, as a real estate agent, take all the risk of having your own business. But then when you're done, you don't really have much to sell. So I didn't like that aspect of it. So I wanted to start buying income properties and offsetting that risk, or what I felt was a risk. So the first deal I did back here was a single family, did everything wrong, basically underestimated budget, timeline, etc. Maxed out a home equity line of credit, maxed out some credit cards, and probably lost $5,000 on the deal after a year. So
It's a learning lesson.
yeah, absolutely. But not all that unique. I think a lot of people have gone through that. And if you have the right attitude, you go out and you do it again, but you do a better job, which is what I did. The next one took 30 days. That netted $50K. And then from there, wanted to get into multifamily stuff. So my brother and I had been looking, and we took all the money we had alongside. We added a third partner to the company, a friend of mine and a neighbor. And we bought a portfolio. I think there were 39 units in the portfolio that we purchased. And it was pretty rough, but we knew we could get in there and allocate some funds to fixing up the units, getting them occupied, and bringing them up to market rate. So that was in early 2018, we closed on that deal. And that was a $1.223 million purchase.
Okay, so let's dig into that one a little bit. So you said it's 39 units.
Yep. So 30 units, some scattered like lots, houses, a bunch of junk we didn't really want. And I think we pulled out, we had $400K in the loan for renovations. What we did is we jumped in there and we were pretty aggressive. We used a lot of our time, obviously, and energy, and found some contractors that were good and some contractors that were bad, and it went through that whole process. But within 11 months, we had turned that around and we were able to refinance that project at the 11-month mark and cash out 85% of the dollars that we put into the deal.
So you pull out 85%. For those that maybe don't understand that fully, let's say they put in, how much cash did you have in the deal? Do you know that number off the top of your head?
Yeah, we each put in 140K. We can make it simple and use round numbers. 450K in the deal.
450K left in the deal. You've got 85% cash out on that. So you're leaving 15% in the deal, which runs, it's around $60,000 left in the deal. And then 65K left. And then what is that deal cash flowing you every month, those 39 units?
So it wasn't a huge number. I would say approximately $4,000 a month. Some mistakes that we made down there, I think are relevant for people to think about when they're doing their first deal, especially if it's an older asset that requires a good bit of maintenance. Realistically, maybe we should have left 50 off to the side, taken most of our money back and left 50 in an account and let it be the kind of reserve cushion, because we would often dig into our monthly cash flow with repairs and upgrades and additional unit turns that we were doing. That hurt the cash flow on that, but it was still a good enough outcome that we were able to then take that money that we had cashed out and we bought an additional 17 units right within a couple of blocks proximity to that. And we did the whole refi and roll thing down there as well. We kind of learned as we went and started leaving more money in the reserves so we could operate them on a more stable basis in terms of cash flow.
But even at the numbers that you just told me, leaving 65 in the deal, if you're cash flowing, even if it's less than $4,000 a month, if you're putting some into repairs and capital expenditures, if it was $4,000 a month flat, you're looking at 48,000 a year divided by 65,000 you got in it. You're looking at a 70% return on the cash that you have stuck in the deal. So a lot of investors are looking for 20% plus cash on cash return. You made out either way. And then you were able to roll that into other investments. Now, building the rest of your portfolio, has that been the method that you've used, adding value, refinancing, taking that cash, and then rolling it into new assets?
Yeah, that's been, I would say, our primary method, although we've done most of the things under the sun that we've heard of or discussed with other people. We've done seller carry, syndicated deals where we've raised outside money, again, injected our own cash back into the company and bought other deals. So we've done a bunch of different avenues to purchase additional properties, but the primary one was the refi and roll method. And that really is what got us started, because that 140K per person that we put in at the time, that was like all the money.
Right.
So we had to make
Right.
it work.
So what does your portfolio look like today?
So today we have right now somewhere around 150 units. Currently, we've sold some stuff off over the past year and a half, just projects that didn't fit our model anymore or were just slightly outside of our area. We've also done a lot of heavy kind of lift construction projects over the last year or so. So we're just finishing up a 62 unit project that we brought 30 of the units online maybe 5 or 6 months ago. And then 32 of the units are coming online at the end of this month. And that was like a vacant and condemned apartment complex, basically. And we kind of brought that all the way back to life. So we do have some of these projects that have been in like heavy construction for a year or so that are just hitting kind of the books right now, which is always a great phase of the project because then they start cash flow and everybody's happy.
Right. And is your plan to refinance out of that as well? Pull your cash back out of that?
We have pretty good debt on that project. So we don't have to do anything on that for another 4 years at this point. And with rates where they are currently, our plan is to just sit on it, let it cash flow. That's a syndicated deal and a great return to our investors on that project, as well as ourselves. And we can decide how we want to handle that 2 or 3, 4 years down the line here. And we'll see what the interest
Right.
does.
What is your expected cash flow on that on a monthly basis?
Yeah, I'd probably have to go and look at that one specifically, but to our side of the deal, so we invested. The way the syndication works is that's when you go out and raise other people's money to purchase the project. There's a limited partnership group and there's a general partner. So we're the general partner in the deal. So we have 30% of that deal. Plus we invested, I think 10% of the $1.5 million raise with our own funds in the limited partnership. So overall we have somewhere around 35 to 40% of that deal. And I think what that means for us on an annual basis, cash flow wise, it's somewhere around, I want to say 75 to 85,000 annually into the company. And then we have a management company that's vertically integrated as well. So there are management fees that go to the management company, which helps support that staff and the things they do within that company. So there's another kind of kicker in there as
That's
well.
incredible. What was the raise like on that? How much money did you need to raise? Like Eric said, so syndication is when you're pulling other people's funds in to be able to fund either the down payment or both the down payment, the renovations, any capital that's needed to execute a deal. So as the general partner, Eric, you put the deal together, you do the work, the sweat equity side, and then the limited partners, they basically just give you the funds to go out and do what you need to do, and they get a certain return on that money. What was your raise on that deal?
Our raise was 1.5 million and we projected approximately a 10-year hold on that deal. And I think our projected returns in our kind of pitch for that were somewhere around 14% on an annual basis to the limited partners. That said, I'm relatively confident that we'll beat that by a pretty good.
That's awesome. Under promise, when your under promise is good, a 14% return, which tons of people are happy with. You under promise, over deliver. And that basically means once they get their money returned back to them, if you did well, they should come back for more and be with you for the future. So That's awesome. And hopefully they're getting a bottle of wine for Christmas also.
By the time they hear this podcast, they'll have the wine.
Yeah. Good, man. That's awesome. So what a lot of the people that are listening to this might just be starting off on their journey and you're a bit further ahead than they are right now. What are some struggles that you ran into along your entire real estate journey? Because we've all run into them that could have veered you off the course and made you say, I don't want to do this anymore. How did you respond to those issues? And how did you keep yourself in the mindset of, I'm doing this investor thing for my best good?
Yeah, there's lots of struggles we make constantly. It's just kind of
Right.
part of the deal. In terms of the most significant ones, that first deal would probably have shied a few people away from real estate. The single family flip that I did, there were many nights at 10 p.m. I had a little baby at home and my wife was at home, and I'd be like laying on the living room floor in that place that was half done, just like staring at the ceiling, like, holy shit, what is going on here? This is not how I picture. Just kind of, I think I looked at that though. I think it's really a lot of it is about mindset and about duration of time and the way you think about time. So for me, I never came in with the attitude that I was going to make a ton of money in a short span of time from real estate. My attitude was always, I really need to understand it and go through some trials and tribulations to get to the point where I could start to make money. And it was always my goal to work full time as a real estate investor of some sort, and knew that if I kept going, that I would eventually get there. And so luckily I, like, by the skin of my teeth on that particular deal, was able to pay off the credit cards to move on
Right.
to the next one. I think it's a lot of it is mindset around the time frame that you're trying to work within. It's relatively, certainly people do it, but it's like pretty unrealistic to think that you're going to start with not a lot of money and
Mm.
then also be able to retire, quote unquote, within a year or something like that. It's certainly a multi-year process in those cases.
And I think a lot of that being able to get the capital after that, if you start with not a lot of money and you only start with one deal, if you can find one deal that gives you a good equity pop so you can pull out that cash and roll it into another deal, similar to how you did with your 39 unit portfolio there. Then you can start buying, rolling it in and buying even more and seeing your portfolio grow and pulling more dollars out to buy more real estate. But that all comes down to finding good deals to buy, especially on your first property. I think good deal is so important and crucial. How have you sourced deals in the past, and what would you recommend as a method for some people out there looking for their first property? How should they source their deals?
I think it's a good time to be getting into real estate. My thoughts are that there's going to be some pretty significant opportunities over the next 6 to 12 months to pick up some legitimate. For instance, that first deal, the 39 unit portfolio that we purchased, that was on net. It had been on
Mhm.
there for months. It was terrible. It
Right.
was super hairy. It was pretty rough. It was priced at 2.1 million. Like I said, we bought it for 1.2 and it was way overpriced. So don't be afraid to go look at something that's, if you have the skill set and the knowledge, don't be afraid to go look at something that is rough that you can go and put your sweat equity into, do a value add type deal. Because if you go out and buy something that's class B or class A that's stabilized and all pretty and ready to go, it's pretty damn hard to add value in a year or two and refi and cash out of that. You almost have to do a value add deal to do a quick refinance and roll type situation. So don't be afraid to
Right.
go get an area deal. And we do all avenues in terms of looking for properties. We just closed on a deal last week, small deal. It's just a 4 unit, but it happens in proximity to a bunch of other stuff that we have. And that was found through a new relationship that we have with a wholesaling company. We're paying them $5,000 a month to go out and market for us off
Mm.
market. And so we put together a creative seller finance / blended like bank deal on that. came to the table, I think, with $8,500. It's a $500,000 property. That'll put 10 to 15K a year into the company. So on an annual and recurring basis. So that's a great example of kind of an off market type deal. We have a lot of broker relationships. We have a lot of good lender relationships. And then we just keep our eyes open too, on the pavement and look for deals. We walk in the front door of a lot of places and talk to the owners of the buildings in these smaller towns that we operate in. And oftentimes
Right.
they're looking to retire and haven't been able to keep the building up the way it should be. And so we go in and figure out a way to make it work. And often we're paying more than the other local folks in the town might pay because they've seen the prices and seen what's happened 20 years ago, but they're not totally current with what can be achieved. So we're happy
What's
to work
going
with
on
them.
right now? Right.
Yeah.
And to see these opportunities, you have to be open to the opportunity. You have to know, hey, I am looking for, whether it be I'm looking for a 4 unit or a 3 unit property, because that type of opportunity might pass you in everyday life. That might literally go past you all the time, but you don't even notice it because you don't have your eyes set on that goal of getting that property. So having that idea of what you need set in your head is so important too, so you can see that.
Yeah. Especially
So
if you're an investor, those 3 to 4 unit properties are like gold mines. You can use FHA loans. You can put low down payments on those. You can finance rehab costs, all on a conventional 30-year loan. Like it's a great opportunity. You have to be willing to live effectively in an apartment building or whatever for a couple of
right.
years. If you're young, and even if you're not young, if you're trying to get into it, there's some sacrifices that have to be made, and at least in my opinion, worth it.
So I think going into that, our
Yeah.
next question here to lead right into that, fastest way to $10,000 in a month in passive income. You start from zero. You're 25 years old. You're working a W-2 job, making $70,000 a year. What's your way? How do you create $10,000 of passive income? What's step one?
Step one for me would you're going to need a down payment of some sort. You probably can save that if you're making 70 grand a year and you're not living a crazy lifestyle, you're single and you're in your mid 20s. You should be able to save about 3.5% of a $500,000 place. And in most parts of the country, I'm not talking about coastal cities, but in many markets, you can go buy a great 4 unit property for about 500K. I would concentrate heavily on trying to buy a 3 or 4 unit property with probably an FHA loan. Get in there, find somebody that needs a little bit of love, put some sweat equity into it, pay your friends with pizza and beer or whatever you have to do to help get them over there to paint a unit or help you lay some flooring, and fix those units up. Live in the crappiest one, fix them up, rent out the nicest one, move to the
Right.
next one, and keep going. Do that over the period consistently over a 12 to 24 month period, and you'll have a renovated 4 unit building that you're living in rent free, certainly, that's cash flowing almost definitely above the operating cost of the property. And then you can take some of those savings that you had from living rent free and go buy the next one, move into that building. You could sell the first one, or if you can swing it, you can figure out a way to get that next down payment, keep that one, let it cash flow, let it pay for the one you just bought. And then it's just a
A
big
snowball.
snowball. Yeah. As soon as you start rolling downhill. Now, sometimes it takes a little while to get it to roll downhill.
Yeah, so let's look at it like this, right? If you're making 70K and let's say you're saving $2,000 a month. Every year that's $24,000. So you want to buy a $500,000 place, you need 3.5% to put down for an FHA loan. So that's 18.5 thousand. I'm pretty sure I did that right. 18, maybe 18,000. Somewhere around $18,000 is what you need. So 1 year working 70K, making 70K, saving 2K a month, you'll be there. You could buy that property. Then when you buy that property, now you're not, let's say you were paying $1,000 a month in rent. Let's not even assume that this place cash flows you while you live there. You're just not paying the $1,000 in rent that you were paying before. Now you make $3,000 a month and you're saving that much. So now you make 36,000 in a year. So now you go buy another property and then you get to move out of your unit, rent that. So now you're making even more money. You make another $1,500 a month. You're saving it each year. It just snowballs and gets bigger and bigger. It allows you to save more money and buy more properties. And that's a pretty traditional, conventional way. If you don't want to go raise other people's money and go buy deals and find deals creatively, it's a pretty solid, proven method that you can get this done within 5 to 10 years. You could build up a passive income around 5 to 10 grand. And if that's all you need to live, you could be done working your W-2 forever.
Absolutely. Don't buy the fancy car. Buy an apartment.
Right. Keep until you have enough apartments where it pays for all your living expenses and all that good stuff. Once you have enough of those apartments and you can buy that stuff where it makes sense financially, then you go buy that stuff. Now, Eric, what is one actionable step? We already started it, but if somebody wants to go buy a 4 unit, what's the next actionable step that our listeners should take to start on their path towards going and finding and buying that 4 unit?
So if they haven't, if we're talking about starting from ground zero, reach out to 3 agents. Spend 30 minutes on Google and find 3 agents that say they specialize in investment real estate. Try to find somebody that looks hungry and aggressive and willing to put in some time with you, i.e. not going to be ages, but like the 65-year-old real estate agent who sells $15 million or $20 million worth of real estate a year is not going to show you 40 shitty apartment complexes so you can find the best one. You need like the younger, just getting into it, aggressive, hungry agent that, he or she is going to go out and rip you through a bunch of deals, because like your $500,000 is 20% of what they're going to, 20% of the deals they're going to have in the year. So you need somebody that's willing to spend the time with you. So I'd say go find a young, hungry agent, listen to a ton of podcasts and create a basic model and go start seeing properties. And then step 2, make an offer.
Right. Make multiple offers too. One thing that I got stuck on in the beginning of my career, and it was good to see this coming from other guys on bigger pockets. So Brandon Turner was like, I'm making 50 offers a week, 100 offers a week. I wasn't doing that. But if I only made one offer and I got stuck on that offer and just hope for it to come in, I wouldn't have gotten the properties that I got because I was making multiple offers. And you can put contingencies in place so you can get out of other offers. As once one is accepted, you could just cancel the other offers. So don't be afraid to make multiple offers. But yeah, educate yourself, go find an agent. Educate yourself so you know what you're looking for and what you want. And then once you know what you want, go find the person that can help you find what you want, which is an agent, and they can represent you. So, Eric, what is our last question here? What's one question that you wish I would have asked, or one topic you wish I would have covered? And how would you have answered, or how would you have expanded upon that topic?
I think something that people focus on, and there's a lot of ways to do it, but sometimes people are super focused on one type of real estate. And I think that's great. You can go inch wide, mile deep. But I would say that we're a little different in the sense that we invest in multiple asset classes of commercial sized real estate. And I always think that's an interesting thing to talk about, because when it comes down to it, we've spent a lot of time getting really good at apartments. And then we spent a lot of time getting really good at small, historic Main Street commercial spaces. And so I would say, don't be afraid to expand your horizons when opportunities present themselves. As long as you do your homework and understand what you're getting into, there's lots of ways to make money in real estate. And it's not just multifamily, and it's not just triple net leases, and it's not just giant apartment complexes. There's tons of girls out there making way more money than me that are just flipping single family houses. That's great. But eventually they get tired of that and they're like, gosh, I should probably buy some multifamily, or I should probably buy some retail, or whatever the case may be. So it's not a terrible thing to expand your scope to take advantage of opportunities when they present themselves.
And it keeps you excited. And in the beginning, the beginning is so important, just to find a good deal. If you pigeonhole yourself into, I am only, and word of caution, I do think the same as you, Eric, that the first best investment you can make is to use your FHA loan and buy a 3 or 4 unit property, because it's the biggest. You can only buy up to 4 units with an FHA, so you might as well max it out, so when you live there, you're not stealing a ton of income from your business. After that, though, if you just say, "I'm a multifamily investor, that's all I do," and then a single family property pops up, like I'm buying one right now, I'm buying it for $35,000. Its value, it's gonna appraise at 140 right away. If I was only a multifamily investor, I would siphon off myself from being able to buy these good deals with equity built into them. Open to just buy a good deal, whatever type of deal it is, make sure it's a good one and buy it. So Eric, where can the listeners and watchers find you online?
ricepegger.com is our typical website. We're also on Instagram under the same handle. So we're out there. Come find us. Always happy to chat, have a conversation. I love talking about real estate. Love going over deals, and always happy to meet new people. So don't hesitate to reach out. My email is eric@rice.
Right. And that's rice as in the food, RICE, and then Pegger is PEGHER. So ricepegger.com. But from the Financial Freedom Fast podcast, we really appreciate the time today, Eric. We got a ton of value out of this. And yeah, man, happy holidays to you. And I'm sure we'll have you on in the future, but we appreciate it.